Right now, thousands of Canadian seniors are losing money every single year. Not because their bank account is illegal, not because they did anything wrong, and not because the CRA has some secret rule nobody told them about. They're losing money because certain deposits, transfers, and retirement withdrawals can quietly trigger extra tax, reduce government benefits, or draw the wrong kind of attention from the CRA. And almost nobody explains how any of it actually works. Here's the thing most people get backwards. Most people think the CRA only cares about how much money you earn. In reality, it's often how your money moves that creates expensive, completely avoidable mistakes. By the end of this video, you'll understand the 3 banking mistakes that quietly cost Canadian retirees thousands of dollars a year, and exactly how to avoid every one of them. Let's start by clearing up something that gets misunderstood constantly. You may have seen headlines, comments, or forwarded messages claiming the CRA has set some kind of limit on how much money you're allowed to keep in your checking account. Let me be completely straight with you. That is not true. There is no law, no CRA policy, and no dollar figure anywhere that limits how much money a Canadian can hold in a personal checking or savings account. You can have $500 in your account or $5 million. The CRA does not care about your balance, and there is no number that triggers a penalty just for existing in your account. So where does this rumor come from? A few real things twisted into something scarier than they actually are. Real thing number 1. Banks and other financial institutions are required by law to report large cash transactions to a federal agency called FINTRAC, the Financial Transactions and Reports Analysis Centre of Canada. This is not the CRA. It's a completely separate agency created to fight money laundering and terrorist financing, not to collect income tax. The rule is this: if you walk into a bank and deposit $10,000 or more in cash in a single transaction, or multiple cash transactions that add up to $10,000 or more within a 24-hour window, your financial institution must file a large cash transaction report with FINTRAC. That's it. That's the actual rule. It applies to physical cash. It does not apply to e-transfers, checks, direct deposits, or electronic transfers between your own accounts. And critically, the transaction itself remains completely legal. Filing the report doesn't mean you did anything wrong. It just means the bank did its job under anti-money laundering law. Real thing number 2. As of mid-2026, there's been real legislative activity in Ottawa around large cash transactions. A bill known as the Strong Borders Act proposed, among many other things, restricting businesses and charities from accepting cash payments or donations of $10,000 or more. I want to be precise here because the details matter, and this is still moving through the legislative process. This proposal targets businesses, professionals, and charities accepting large cash payments, not individual Canadians keeping money in their personal bank account. It has nothing to do with how much you can hold in your checking account, and nothing to do with normal retirement income like CPP, OAS, or RRIF withdrawals landing in your account by direct deposit. So, when you put those 2 real things together, a $10,000 cash reporting rule that's existed for years, and recent news about cash payment restrictions for businesses, it's easy to see how a rumor mutates into the CRA set a limit on your checking account. But that's not what either of those rules actually says. Here's the actual danger, and it has nothing to do with a dollar limit. The danger isn't having money in your account. The danger is not understanding how the system actually works, specifically, how retirement withdrawals get taxed and how they can push you into a higher bracket or cost you government benefits. How the CRA looks at deposits when your reported income doesn't match your spending or your bank activity, not because of a magic number, but because of unexplained gags. How certain banking habits, mixing accounts, tossing out records too early, assuming transfers are automatically fine, can turn an innocent transaction into a months-long headache. That's what this video is actually about. Let's go through all 3, with real numbers and real examples. The single biggest banking mistake retirees make isn't about deposits at all. It's about how they take money out of their registered accounts. Here's why this catches so many people off guard. During your working years, taxes felt simple. One job, one T4, tax deducted automatically. In retirement, you suddenly have multiple income sources. CPP, OAS, maybe a pension, RRSP or RRIF withdrawals, and every single one of them adds to your tax bill differently. If you don't understand how, the CRA will happily let you find out the hard way at tax time. Let's start with RRSP withdrawals. If you take money out of your RRSP before converting it to a RRIF, that withdrawal is fully taxable income in the year you take it. Your financial institution will withhold tax at source, but here's the part that surprises people. The withholding at the time of withdrawal is often not enough to cover what you'll actually owe. The standard withholding rates outside Quebec are 10% on withdrawals up to $5,000, 20% on withdrawals between $5,001 and $15,000, and 30% on withdrawals above $15,000. Those percentages are withholding, a prepayment toward your tax bill, not your final tax rate. If your marginal tax rate is higher than the withholding rate, which is common once you add CPP, OAS, and other income together, you'll owe more when you file. Retirees are routinely caught off guard every April because they assumed the tax was already handled when the bank withheld 20%. Now let's talk about RRIF withdrawals, because this is where it gets serious. Once you turn 71, your RRSP must be converted into a RRIF, a Registered Retirement Income Fund, by December 31st of that year. From the following year onward, the CRA requires you to withdraw a minimum amount every single year, whether you need the money or not. The minimum is calculated by multiplying your RRIF's value on January 1st by a percentage the CRA sets based on your age. For 2026, here's what that looks like. At age 71, 5.28%. At age 75, 5.82%. At age 80, 6.82%. At age 85, 8.51%. At age 90, 11.92%. Here's a real example. Say you're 80 years old with a $500,000 RRIF. Your mandatory minimum withdrawal this year is about $34,100, and every dollar of it is taxable income, whether you spend it, save it, or simply move it into a regular savings account. One detail that genuinely surprises people: there is no tax withheld at source on the RRIF minimum amount. Your institution sends you the full minimum without deducting anything. That feels good in the moment, but it means the entire amount is added to your taxable income with nothing held back. And if you haven't planned for it, you can end up owing a meaningful amount at tax time. If you withdraw more than the minimum, the excess is subject to the same withholding tiers as RRSP withdrawals: 10%, 20%, or 30%, depending on the amount. Why does this push people into higher tax brackets? Because the CRA adds everything together. Let's say you're 80. You have that $500,000 RRIF generating a $34,100 mandatory withdrawal, plus CPP of around $900 a month. That's $10,800 per year. Plus OAS at roughly $743 a month. That's $8,916 per year. For someone 75 plus, the rate is actually higher, about $817 a month or $9,799 a year, due to the 10% age 75 top-up. Add those together, and you're already at roughly $54,600 before a single dollar of pension income, investment income, or part-time work is added. That's not catastrophic on its own, but add a modest workplace pension or some investment income, and you can cross into territory that triggers something even more painful than a higher bracket: the OAS recovery tax, commonly called the OAS clawback. Here's the number that matters most. For the 2026 income year, the OAS clawback threshold is $95,323 in net income. For every dollar above that threshold, the government claws back 15 cents of your OAS. Push your income high enough, roughly $152,062 for those 65 to 74, and your entire OAS is gone. This is the single most common way retirees accidentally cost themselves thousands of dollars. A RRIF minimum withdrawal that, combined with other income, tips them over the clawback threshold without anyone realizing it was coming until the notice of assessment shows up. The age credit gets hit too. there's a federal non-refundable tax credit for Canadians 65 and older, called the age amount. As of 2026, it starts to be reduced once your net income passes roughly $45,522 and phases out completely at higher income levels. Large RRIF withdrawals that push your income up don't just risk OAS, they can also shrink this credit. A real-world example to tie this together. Margaret is 81. Her RRIF is worth $420,000. Her mandatory minimum this year, at the age 81 rate, is about 6.99%, roughly $29,358. Add CPP of $11,000 and OAS 75 plus rate of about $9,799, and her income before anything else is already around $50,157. That's fine. She's nowhere near the clawback threshold yet. But suppose Margaret also needs $20,000 this year for a roof repair, and she pulls it from her RRIF as an extra withdrawal on top of the minimum. That pushes her total income to roughly $70,157 for the year, still under the OAS threshold, but now she's paying tax on that $20,000 at her marginal rate. Plus 20% was withheld at source on the excess, which may or may not match what she actually owes. If Margaret had that $20,000 sitting in a TFSA instead, she could have pulled it out completely tax-free, with zero impact on her income, her OAS, or her age credit. That's the difference proper planning makes. Same need for cash, completely different tax outcome, depending on which account the money comes from. The fix isn't complicated, but it does require knowing your numbers each year. Know your RRIF minimum before the year starts, so it's never a surprise. If you need extra cash beyond the minimum, check whether a TFSA withdrawal could cover it instead of an additional RRIF withdrawal. TFSA withdrawals don't count as income at all. If you're under 71 and in a low-income year, consider voluntary RRSP withdrawals now at a lower tax rate, rather than waiting for mandatory withdrawals to force larger amounts out later at a higher rate. Ask your financial institution to withhold additional tax voluntarily if you know your marginal rate is higher than the standard withholding tiers. It's a simple form, and it prevents a surprise bill in April. That's mistake number 1. Now let's talk about something completely different. What happens with deposits, and why the CRA might actually take a closer look at your account. I want to repeat something important before we go further. This is not about a dollar limit. There is no specific deposit amount that automatically gets you flagged. What actually matters is documentation, whether you can explain where money came from if anyone ever asks. Let's go through exactly how this works in practice, how the CRA actually identifies potential problems. The CRA doesn't sit there watching your bank account in real time. Banks don't send the CRA a running log of your deposits. What actually happens is more targeted, and it usually starts with one of two things. The CRA's risk assessment system flags a tax return that looks inconsistent. For example, reported income that seems too low to support a person's apparent lifestyle, spending, or assets. Or during an audit, for almost any reason, the CRA requests bank records and compares the deposits in your accounts to what you reported as income. When the CRA does this kind of comparison, it's officially called indirect verification of income, and the most common version of it is the net worth method. Here's how it actually works. The CRA adds up your assets and liabilities at the start of a period, compares them to your assets and liabilities at the end, factors in your living expenses, and compares the result to what you reported in income. If your wealth grew by more than your reported income can explain, the CRA can reassess you for unreported income, and the burden then falls on you to explain the difference, not on the CRA to prove wrongdoing. I want to be clear about who this typically applies to. Net worth audits are most associated with self-employment income, cash-based businesses, or situations where books and records look unreliable. Mixing personal and business accounts is a classic trigger. A typical retiree living on CPP, OAS, and RRIF withdrawals reported on T4A and T4RIF slips is not a common target for this kind of audit. But if you have any side income, consulting, contract work, a small rental property, cash-based work, or if a large, unexplained deposit shows up that has no obvious source. This is the mechanism that can pull you into closer scrutiny. So what kinds of deposits actually raise questions? Let's go through the ones that confuse people most, because in almost every case, the deposit itself is completely fine. The problem is only ever a lack of documentation. Gifts from family. Here's something that surprises a lot of Canadians. There is no gift tax in Canada. None. You can receive $5,000 from your daughter or $200,000 from your father, and you owe zero tax on that gift, and you don't even need to report it as income. The same is true in reverse. You can gift money to your kids or grandkids without any tax consequence to you, as the giver, as long as it's cash and not appreciated property. There is one wrinkle worth knowing. If you gift money to your spouse or a minor child and they invest it, any income that money earns, interest, dividends, generally gets attributed back to you for tax purposes under what are called the attribution rules. The gift itself is still tax-free. It's the income generated afterward that gets attributed back. The practical tip here: if a family member sends you a large gift, keep a simple record: an email, a text, a note saying what it was and who it came from. You'll likely never need it. But if a large, unexplained deposit ever comes up in a review, having that documentation turns a 5-minute conversation into a non-issue. Inheritances. Same principle. Canada has no inheritance tax for the person receiving the inheritance. If your sibling passes and leaves you $150,000, you don't pay tax on that money. The deceased's estate handles any tax owing through what's called deemed disposition. Basically, the estate is treated as if it sold all the assets at fair market value right before death, and any tax from that gets paid out of the estate before you receive your share. What you do want to keep is the documentation trail, the executor's letter, the estate settlement statement, anything showing the source of the funds. If that large deposit ever needs explaining, that paperwork is exactly what resolves it instantly. Transfers between your own accounts, moving money from your TFSA to your checking account, or between two accounts at different banks, that is not new income. It's not a deposit that needs explaining in the income sense. It's literally your own money moving from one pocket to another. The confusion usually comes from a bank's fraud prevention systems flagging an unusual transfer pattern, which is a completely different thing from a CRA tax issue. If your bank calls to verify a transfer, that's standard fraud protection, not a tax problem. Selling personal property. Sold your car, your furniture, some jewelry, a boat. In most cases, selling personal use property for less than what you paid for it doesn't create a taxable gain, and the deposit from the sale isn't new income in the way employment or investment income is. The exception is if you sell something for a significant gain above its original cost, collectibles, certain valuable items, which can occasionally trigger capital gains rules. For an ordinary used car or furniture sale, this is rarely an issue. But if you sell a higher value item, keep a record of what you originally paid and what you sold it for. Now here's where real risk does exist, and this is the part retirees genuinely need to hear. If you have unreported cash income, say you do occasional handyman work, sell items regularly, or run a small side business and take payment in cash or e-transfers without reporting it, those deposits absolutely can become a problem. The CRA's indirect verification methods are specifically designed to catch situations where deposits consistently exceed reported income with no other explanation. Courts have repeatedly upheld the CRA's use of these methods, and the burden of proof falls on you to explain the gap. If you mix business and personal banking, using one account for both your part-time consulting income and your everyday groceries, that's one of the specific patterns that makes the CRA more likely to apply the net worth method, because it becomes nearly impossible to cleanly separate what's income and what's just money moving around. The bottom line for this section: the CRA is not watching your checking account balance, and there is no deposit amount that automatically triggers a problem. What actually matters is whether you can explain where money came from, if you're ever asked. And that almost always comes down to simple record keeping, not the size of any single deposit. Let's move to the third mistake, and this one costs more retirees money than the first two combined, because it's the one nobody explains until it's too late. This mistake isn't about taxes in the traditional sense. It's about how the timing and source of your income, which is really a banking and withdrawal decision, can silently shrink the government benefits you're entitled to. Let's start with the OAS recovery tax, because it's the one that affects the most people. We touched on this in mistake number 1, but it deserves its own spotlight because it's driven almost entirely by which account your money comes from, a decision that's completely within your control. The 2026 threshold is $95,323 in net income. Above that, you lose 15 cents of OAS for every dollar over the line. The maximum OAS for someone 65 to 74 is about $742.31 a month, or roughly $8,907 a year. So a retiree who crosses well into clawback territory can lose thousands of dollars annually, every year, for as long as their income stays elevated. Here's the part that matters for this video. TFSA withdrawals do not count toward this calculation at all. Not partially, not at all. The CRA simply does not see TFSA withdrawals when it calculates your net income for OAS purposes. A RRIF withdrawal of $20,000 and a TFSA withdrawal of $20,000 put the exact same amount of spending money in your checking account, but one of them can cost you OAS and the other never will. This is purely a banking and withdrawal sequencing decision. Two retirees with identical net worth and identical spending needs can end up with completely different OAS outcomes, simply based on which account they draw from first. GIS is even more aggressive. The Guaranteed Income Supplement is available to lower-income seniors who also receive OAS. The maximum for 2026 is $1,109.85 a month for a single senior, over $13,000 a year, completely tax-free. But GIS is reduced by 50 cents for every dollar of other income. That is an extremely steep reduction rate. A retiree who qualifies for GIS and then makes a withdrawal from a taxable account instead of a TFSA can lose a meaningful chunk of that benefit for the entire following payment year, because GIS eligibility is reassessed annually based on the prior year's reported income. And here's the detail that trips people up the most. TFSA withdrawals do not count as income for GIS purposes either. This makes the TFSA for lower-income seniors specifically one of the most powerful tools available, because it's the one source of spending money that genuinely doesn't cost you GIS. A real example. Take Harold, 74, single, living mostly on CPP and a small workplace pension, totaling about $19,000 a year, plus OAS. Because his income is modest, he qualifies for a partial GIS payment. One year, he needs $8,000 for a furnace replacement. He has the money in both a small non-registered investment account and a TFSA. If Harold pulls the $8,000 from his non-registered account and it includes $1,500 of capital gains, half of that, $750, is taxable and adds to his net income. That addition reduces his GIS for the following year by roughly $375, 50 cents per dollar, on top of the income tax owed on the gain. If Harold pulls the same $8,000 from his TFSA instead, none of it counts as income. His GIS for next year is untouched. Same furnace, same $8,000, completely different outcome, purely because of which account he chose. Pension income splitting is the other lever worth knowing about here, because it directly affects whether you cross the OAS threshold in the first place. If you're 65 or older and have eligible pension income, RRIF withdrawals, or a workplace pension, you and your spouse can jointly elect, using CRA Form T1032, to shift up to 50% of that income onto the lower-earning spouse's tax return. No money actually moves between your bank accounts. It's a paper election filed with both of your tax returns. This matters here because it directly lowers the higher-earning spouse's net income on paper, which can pull them back under the OAS clawback threshold entirely, even without changing a single banking habit. For couples where one spouse has most of the RRIF income, this is consistently one of the highest value moves available, and it costs nothing to elect. Capital gains timing matters too. If you hold investments outside your registered accounts, remember that capital gains are taxed at a 50% inclusion rate in 2026. Half of any gain gets added to your income. Selling a large position in 1 year, say to fund a big purchase, can spike your income enough to trigger OAS clawback or reduce GIS, even though the underlying need was a one-time event. Spreading a large sale across 2 or 3 tax years, where possible, keeps each year's taxable gain lower and reduces the chance of crossing into clawback territory. Let's bring it together with the order of operations that actually protects your benefits. When you need extra cash in retirement, the general order that minimizes damage to your taxes and your benefits is TFSA first, since it never counts as income. Then non-registered investments, ideally timed and paired with any available capital losses to offset gains. Then RRIF withdrawals beyond the mandatory minimum, since these are fully taxable and the most likely to push you over a threshold. This isn't a rule that applies identically to everyone. Your own mix of accounts, income, and benefit eligibility changes the math. But understanding that the source of a withdrawal is just as important as the amount is the single biggest mindset shift that protects retirees from accidentally losing benefits they've earned. Let's pull all 3 mistakes together into something you can actually act on this week. 1. Know your RRIF minimum before the year starts. Calculate it using your age and your January 1st balance, so a mandatory withdrawal never surprises you mid-year. 2. Match your withdrawal source to your need. If you need extra cash beyond your RRIS minimum, check your TFSA first. It doesn't count as income, doesn't affect OAS, and doesn't affect GIS. 3. Keep records of large, unusual deposits. Not because you're required to prove every dollar, but because it makes any future question a 5-minute conversation instead of a stressful one. This applies especially to gifts, inheritances, and proceeds from selling higher value property. 4. Don't mix personal and any side business income in the same account. If you do any cash work, consulting, or small business activity in retirement, keep it in a separate account. This single habit is one of the biggest factors in whether the CRA applies indirect verification methods to your finances. 5. Keep your tax records for at least 6 years from the end of the tax year they relate to. This is the CRA's standard retention rule, and it covers receipts, RRSP and TFSA contribution slips, T4 slips, and anything supporting a deduction or credit you claimed. 6. If you're married or in a common law relationship, and one of you has significantly more pension income, look into pension income splitting using Form T1032. It costs nothing, requires no money to move, and can be the difference between keeping or losing OAS. 7. If your income is creeping close to $95,323, or you receive GIS and you're planning a large withdrawal or sale, talk to a tax professional or fee-only financial planner before you pull the trigger, not after. The difference between drawing from the right account versus the wrong one in the same year can be thousands of dollars. None of this requires hiding money, avoiding banks, or worrying about some arbitrary limit that doesn't exist. It requires understanding 3 things: how withdrawals get taxed, what documentation protects you, and how the source of your income, not just the amount, determines whether you keep the government benefits you've earned. If this cleared something up for you, share it with a parent or a retired friend who's heard the checking account limit rumor. They'll want the real version, not the scary one. Drop a comment below. Have you ever had a withdrawal or a deposit raise a question you weren't expecting? Let me know what happened. I read every comment. Subscribe for plain English breakdowns of CRA rules, CPP, OAS, and Canadian retirement banking every week.